There's a fund that has handed its investors a raise 15 years in a row. Not once has it skipped. Not in 2020 when the economy shut down, not in 2022 when the market fell apart and the S&P 500 dropped almost 20%. Every single year, like clockwork, the check got bigger. That fund is SCHD, Schwab's U.S. Dividend Equity ETF. And right now, it pays you almost 3 times more income than VOO, the S&P 500 fund most people already own. Same money in, nearly 3 times the paycheck coming out. Today, I'm going to show you exactly how big that gap is on real dollars, whether that famous 9% a year raise is actually real or just a number people repeat online. And the one account decision, this is the part almost everyone gets wrong, that decides whether you keep every penny of that growing income or hand a slice of it to the IRS every 3 months. Here's the part that surprises people the most. There's a version of this exact fund where you never pay a dime of tax on any of it. Same shares, same dividends. And there's a version where the government quietly takes a cut 4 times a year. The only difference is one choice, a choice most people make without even thinking about it. Quick note, I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So let's settle it. SCHD versus VOO. Not which one grew the biggest pile, which one actually pays you and gives you a raise just for holding it. The paycheck that pays 3 times more. Let's start with the number in the thumbnail, because that's the promise, and I'm going to back it up right now. Say you put $100,000 into SCHD today. At about 3%, it pays you roughly $3,140 a year in dividends. That's real cash, about $785 landing in your account every quarter. You didn't sell anything, you didn't do anything, the money just shows up. Now the same $100,000 in VOO, and yes, VOO pays a dividend too, most people forget that part, but its yield is only about 1.1%, that's roughly $1,100 a year, on the exact same $100,000. Before I say the next part, take a guess, how much more does SCHD pay? Twice as much? 3 times? Hold your number for a second. $3,140 versus $1,100. That's almost 3 times the income from the same investment on the same day in the same market. Now, here's where it gets real for someone actually close to retirement. Most people watching this aren't playing with $100,000, so let me redo the whole thing with a number that's closer to home. Say you're 55, you've spent 30 years saving, and now you've got $500,000 you're ready to put to work. In SCHD at 3%, that's about $15,000 a year. $15,000 hitting your account without touching a single share. That same $500,000 in VOO, about $5,300. So which one pays the bills? It's not close. SCHD hands you almost $10,000 a year more in actual spendable income, and you still own every share you started with. But here's what most people miss about that $15,000. It doesn't just sit there at 15, it grows, and that is the part of this story that actually matters. The raise you never have to ask for. Here's what makes a dividend fund different from a job at a job. At a job, you have to earn a raise, ask for it, fight for it. With SCHD, the raise just happens. And it's not random. SCHD only holds about 100 companies, and they have to pass a strict screen, solid balance sheets, strong cash flow, and at least 10 straight years of paying dividends. Names like Coca-Cola, Home Depot, Chevron, PepsiCo, boring, steady, cash-generating machines. That quality is what funds the raise. Over the last 10 years, SCHD has raised its dividend about 9% a year on average. Let me show you what 9% actually does, because it sounds small until you watch it work. Go back to that $3,140 on $100,000. Let me walk it forward, out loud, in real time. Year 1, you're getting about $3,140. Grow that 9% a year. By year 5, you're up around $4,800. Keep going. By year 9, same $100,000, you never added a dollar, you never sold a share, you're collecting about $6,800 a year. That's the thumbnail. $3,140 turning into $6,800. Your income more than doubled while you sat there and did nothing. Now I'm going to be straight with you because I'm not here to sell you a fantasy. That 9% is a 10-year average. Some years were huge. SCHD raised the payout almost 18% back in 2020. But last year's raise was smaller, closer to 5%. So no, it won't be exactly 9% every single year. Some years more, some years less.
But here's the number that really matters. In 15 straight years, SCHD has never once cut its dividend. Not in a crash, not in a recession. 15 years. Every year, the check went up. And even if the raise slows to a calmer 7%, that $3,140 still nearly doubles by year 12. Think about what that means if you're retired. Your costs climb every year. Groceries, insurance, everything. Most retirement income just sits flat while inflation quietly eats it alive. A raise that shows up on its own every year without you lifting a finger, that's not a nice to have. That's the whole game. So, quick gut check. If you could only hold one of these for the next 10 years, the one that grows the biggest pile, or the one that pays you more and raises that pay every year, which one are you? Tell me in the comments. I'm genuinely curious which way this audience leans. The honest part. What VOO still does better. Now, if I stopped right there, you'd walk away thinking SCHD wins hands down. It doesn't. And if you've watched other videos on this, you've probably heard someone insist that VOO crushes SCHD. Here's the truth. They're not wrong. Over the last 10 years, $100,000 in VOO grew to more than $400,000. That same money in SCHD, closer to $340,000. Depending on exactly when you measure, VOO came out somewhere around $70,000 to $90,000 ahead. VOO won the decade. On total growth, it wasn't even close. And I'm not going to pretend otherwise, because you deserve the real picture, not a sales pitch. So, why did VOO win? 7 companies. VOO holds 500 stocks, but the top 7, Nvidia, Apple, Microsoft, a few others, make up over 30% of the entire fund. When those tech giants exploded, VOO went straight up with them. SCHD doesn't own that concentration. That's the whole reason it grew slower. Now, here's the myth that trips people up. Here's the myth. A dividend is free money, a bonus stacked on top of your returns. Here's the truth. On the day SCHD pays you, its share price drops by exactly that amount. The dividend doesn't fall from the sky. It comes out of the fund. So you can't just add SCHD's dividend on top of its growth and call it a free win. What actually matters is total return, the price plus the dividends combined. And on that scoreboard, over the last 10 years, VOO came out ahead. So why are we even having this conversation? Because, and this is the reframe, growth and income are not the same job. VOO's job is to build the pile while you're still working. SCHD's job is to pay you from the pile without forcing you to sell it. Asking which one is better is like asking whether a ladder is better than a chair. Depends what you're trying to do. And that difference is bigger than it sounds when you're the one pulling income. Think about it. If you're retired and a crash hits, and your money's all in VOO, you're selling shares at the bottom just to pay your bills, and those shares are gone. But if SCHD's dividend already covers a big chunk of your spending, you don't have to sell into the crash. You just collect the check and wait it out. And here's a twist. That decade where VOO dominated, it may not repeat. Watch this. In 2022, when the market fell apart, VOO dropped over 18%. SCHD, down just 3%. And right now, in 2026, the boring fund everyone wrote off is up about 28% this year. VOO's up about 13%. The tide turns. It always does. The tax that quietly eats your dividends. Quick question before we keep going, and this is the one I really want you to answer. Are you holding SCHD, VOO, or both right now? And just as important, what account is it in? A Roth, a regular IRA, or a taxable brokerage account? Drop it in the comments. Tell me the account, not just the fund, because the account is where this whole thing is won or lost. I read every single one. Here's why I'm asking. That growing income we just talked about, in the wrong account, the IRS takes a bite out of it every 3 months, whether you spend the money or not. Watch. Say you've got that $500,000 in SCHD sitting in a regular taxable brokerage account. It pays you about $15,000 a year. Now, the good news, SCHD's dividends are what's called qualified. That means you're taxed at the lower rate, not your regular income rate. For most people, that's 15%. But 15% of $15,000 is about $2,250. Every year, gone. And remember, that dividend grows, so your tax bill grows right along with it. Over 10 years, you could hand well over $25,000 to the government, money that could have stayed invested and kept paying you. And to get sharper if you've already claimed Social Security, there's a trap called the Social Security torpedo. Here's how it works. The IRS adds up your income plus half your Social Security plus your dividends. Cross a certain line, for a married couple it's around $44,000. Suddenly, up to 85% of your Social Security becomes taxable too. So one extra dollar of dividends can drag your Social Security check into the tax net. People in that zone think they're in the 22% bracket. They're really paying over 40% on that dollar.
Then there's the second cliff called IRMA. That's a surcharge tacked onto your Medicare premiums. Cross about $218,000 as a couple and your Medicare costs jump by more than $1,000 per person. And it uses a 2-year look back. Your income today sets your premium 2 years from now. You won't even see it coming. So if you've got a spouse or a friend keeping a big dividend fund in a plain taxable account, send them this next part right now, because here's the fix, and it's simpler than everything I just described. The account map. SCHD income done right. Here's the move, and once you see it, you can't unsee it. Put SCHD in your Roth IRA. That's it. That's the fix. Inside a Roth, you already paid the tax on the money going in, so everything that happens after is yours. Every dividend, every raise, forever. No 15% bite, no Social Security torpedo, no IRMA surprise. That $15,000 a year growing to $20,000, $30,000, $40,000, you keep all of it, every penny, tax-free for life. And VOO? VOO goes in your taxable brokerage account. Here's why that works. VOO barely pays a dividend, so there's almost nothing to tax year to year. It just grows quietly, and you don't owe a dime until the day you actually decide to sell. You control the timing. Growth belongs where taxes are deferred. Income belongs where taxes disappear. Now, let me show you why this matters so much. Let me put real numbers on it. Say you're 55 and you put that $500,000 into SCHD inside a Roth. Watch what the income does, completely tax-free, if that dividend keeps growing at its historical pace. Let me read those out, because every one of them matters. At 55, about $15,000 a year. At 60, about $23,000. At 65, about $35,000. At 70, about $55,000. And at 75, about $84,000 a year. You never added a dollar, you never sold a share. And because it's in a Roth, every one of those dollars is tax-free. Here's what makes that really land. The average Social Security check right now is about $2,070 a month, roughly $24,800 a year. So by the time you're 65, your SCHD income alone has already passed a full Social Security check. By 70, it's more than double. And even if growth slows to that calmer 7%, this income still nearly doubles by 65 and more than triples by 75. That's a second Social Security, one you built yourself and one that gives itself a raise every year. So here's what I want you to remember. If you write down one thing from this entire video, make it this. A great retirement paycheck does two things. It grows every single year, and it lands in an account the tax man can't touch. Get those two right, and it stops being a fight over which fund is better. It becomes income that pays you, raises you, and protects you. That's the whole game. If someone you know is trying to decide between SCHD and VOO right now, or worse, has their dividends sitting in the wrong account, share this video with them. This is the part they need to hear. And I want to know, what's your split right now? All SCHD, all VOO, somewhere in between? Drop your ratio in the comments. I read every single one. If you're building income you can actually retire on and you want to stay ahead of the tax traps and market shifts most people never hear about, subscribe to the channel. We break this down every single week.